Welcome to a new video where we delve into the world of investment. Today we are focusing on top 3 dividend ETFs in Canada. In the realm of investing, there's a vast array of options, each with its unique features and potential benefits. But today, we're going to narrow our scope and shine the spotlight on a particular type of investment vehicle, dividend exchange traded funds, or dividend ETFs for short. Now you might be wondering, what exactly are dividend ETFs? Well, they're a type of investment fund and exchange-traded product listed on a stock exchange. They own assets such as stocks, commodities, or bonds and aim to pay an income to investors from the dividends and interest earned from these assets. Why are they important, you ask? Well, dividend ETFs offer a host of advantages to investors. Firstly, they provide a steady income stream. The dividends earned from the stocks within the ETF are paid out to investors, which can be a reliable source of income, especially in times of market uncertainty. Secondly, they offer diversification. Instead of buying individual stocks, when you invest in a dividend ETF, you're investing in a basket of different stocks. This helps spread the risk and can provide a more stable return over the long term. Moreover, they're accessible and easy to trade. Just like individual stocks, you can buy and sell ETF shares on a stock exchange during the trading day. This flexibility, combined with the potential for a steady income and diversification, makes dividend ETFs a compelling choice for many investors. But not all dividend ETFs are created equal. There are several factors to consider when choosing which one to invest in, such as the ETF's dividend yield, its portfolio of stocks, and its expense ratio. That's why we're here today to guide you through our top 3 picks for dividend ETFs in Canada. Now that we have an understanding of dividend ETFs, let's dive into our top 3 picks in Canada. Hello viewers, if you are enjoying this content, and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us, and remember to comment and share. Starting off our list is the Vanguard FTSE Canadian High Dividend Yield Index ETF, popularly known as VDY. This attractive financial instrument has been making waves in the investment world, and for good reasons. But before we delve into the specifics, let's first understand what VDY is. VDY is an exchange-traded fund managed by Vanguard, one of the world's leading investment management firms. It tracks the FTSE Canada High Dividend Yield Index, which is comprised of Canadian stocks that are characterized by high dividend yields. Essentially, this ETF is designed to provide investors with a steady stream of income through dividends, which can be a significant advantage, especially in volatile market conditions. One of VDY's main features is its focus on sectors known for their high dividend yields. These include financials, energy, and utilities. By investing in companies within these sectors, VDY aims to provide investors with a higher yield than many other ETFs in the market. Now let's talk about performance. Over the years, VDY has consistently demonstrated strong performance. It has outperformed many of its peers in the Canadian market, making it a compelling choice for investors seeking both growth and income. In fact, since its inception in November of 2012, VDY has provided an average annual return of around 5%. This performance is largely driven by the ETF's diversified portfolio. VDY holds an array of stocks from various sectors, which can help to mitigate risks associated with market volatility. This diversification, coupled with the fund's focus on high-yield sectors, has allowed VDY to maintain its performance and continue providing investors with a steady stream of dividend income. In terms of yield, VDY does not disappoint. It has a trailing 12-month yield of about 4.5%. This is considerably higher than the average yield of many other Canadian ETFs. It's worth noting that while past performance is not necessarily indicative of future results, VDY's consistent track record does provide a certain level of reassurance. But what makes VDY a good investment choice? Well, it's a combination of factors. Firstly, its focus on high-yield sectors makes it an attractive option for income-focused investors. Secondly, its robust performance and high yield make it a compelling choice for those seeking both growth and income. Additionally, with its diversified portfolio, VDY can offer a certain level of protection against market volatility. Furthermore, VDY's low expense ratio of just 0.22% makes it an affordable choice for investors. This low cost, coupled with its strong performance and a high yield, can make VDY a valuable addition to any investment portfolio. Of course, like any investment, VDY carries certain risks. These include market risk, sector concentration risk, and the risk associated with investing in high-yield stocks. However, with careful planning and a long-term investment strategy, these risks can be effectively managed. In conclusion, VDY, with its impressive performance, high yield, and focus on high dividend sectors, offers a compelling investment proposition. Whether you're an income-focused investor or someone seeking both growth and income, VDY could be a suitable option for you. VDY, with its impressive performance and high yield, certainly earns its spot in our top 3. Next on our list is the iShares S&P/TSX Composite High Dividend Index ETF, or XEI for short. Let's delve into what XEI is all about. XEI is one of Canada's largest exchange-traded funds, designed to offer investors exposure to Canadian companies that are leaders in yielding dividends. This ETF operates under the umbrella of BlackRock, one of the world's largest investment managers, and is listed on the Toronto Stock Exchange. So, what sets XEI apart? First, let's talk about its unique portfolio. XEI provides a diversified exposure to high dividend-yielding Canadian companies. It does this by tracking the performance of the S&P/TSX Composite High Dividend Index, hence its name. This index consists of 50 of the highest dividend-yielding companies within the S&P/TSX Composite Index, spanning across various sectors. Thus, XEI's portfolio is a mix of some of Canada's best dividend payers, a blend of stability and potential growth. Now, let's discuss its performance. Since its inception in April of 2011, XEI has been known for its consistent performance. It has maintained a steady growth trajectory, reflecting the robust performance of its underlying index. As of the end of November 2024, XEI has an annualized return of about 4.5% over the past 5 years, which is quite impressive considering the market volatility during this period. Let's not forget about the yield. The yield is the annual income an investor receives from an investment. As of November 2024, XEI boasts a trailing 12-month yield of approximately 5.2%. This means that for every $100 you invest in XEI, you can expect to receive about $5.20 in dividends over a year. That's a pretty attractive return, wouldn't you say? Now onto the sectors it invests in. XEI's portfolio is diverse, spanning across a broad range of sectors. It includes companies from the financial sector, the energy sector, the materials sector, and so on. This diversity is what makes XEI a resilient investment choice. It ensures that the performance of the ETF is not overly dependent on any single sector, thus minimizing risk. So why should you consider XEI as a part of your investment portfolio? Well, XEI offers a high yield, consistent performance, and diversified exposure to Canadian companies. It's a great way to generate passive income while also potentially benefiting from the growth of these companies. Moreover, XEI's low expense ratio of 0.2% makes it a cost-effective investment choice. However, like any investment, XEI comes with its own set of risks. The performance of XEI is tied to the performance of its underlying index. If the companies in the index fail to perform well, the value of XEI could decrease. Therefore, it's important to carry out your own due diligence before investing. All in all, XEI is a robust and reliable choice for those looking to invest in dividend-yielding ETFs. It's well established, it's backed by a reputable investment manager, and it's got a track record of consistency. Plus, it's an excellent way to gain exposure to the Canadian market and potentially benefit from the growth of some of Canada's top dividend-paying companies. XEI, with its diversified portfolio and consistent performance, is definitely one to consider. Last but not least, we have the iShares S&P/TSX Canadian Dividend Aristocrats Index ETF, known as CDZ. Now let's dive deeper into this fund to understand what makes it one of the top dividend ETFs in Canada. CDZ is designed to measure the performance of publicly listed high dividend yield companies in Canada. Specifically, the fund focuses on those companies that have followed a policy of consistently increasing dividends every year. This makes CDZ a compelling choice for investors seeking a steady stream of income. So what sets CDZ apart? Well, first off, this ETF is based on the S&P/TSX Canadian Dividend Aristocrats Index. The term aristocrats refers to companies that have a history of consistently increasing their dividends. These are typically mature, profitable businesses that have shown resilience through various economic cycles. In terms of performance, CDZ has demonstrated a strong track record. Over the past decade, the fund has delivered an average annual return of about 6%. While this may not seem extraordinarily high, Remember that the primary goal of a dividend ETF is to provide consistent income, and not necessarily to achieve sky-high capital gains. Now, let's talk about the yield. As of the end of last year, CDZ had a trailing 12-month yield of about 4.5%. This is significantly higher than the yield on the average savings account, making it an attractive option for income-focused investors. Another key aspect of CDZ is its sector allocation. The fund is well diversified across a range of sectors, reducing the risk associated with overexposure to any single industry. The top sectors in CDZ's portfolio include financials, utilities, and energy, among others. This broad sector exposure can provide a level of stability to your portfolio, especially during times of market volatility. But why should you consider adding CDZ to your investment portfolio? Well, there are several reasons. Firstly, CDZ's focus on dividend aristocrats means that the fund is invested in companies that are proven performers. These companies have a track record of not just paying dividends, but increasing them over time. This can provide a reliable and growing income stream for investors. Secondly, with its broad sector exposure, CDZ can offer a level of diversification that can help buffer your portfolio against market downturns. It's often said that it's not wise to put all your eggs in one basket, and this is especially true when it comes to investing. By spreading your investments across a range of sectors, you can reduce the risk of a significant loss if one sector underperforms. Finally, the relatively high yield offered by CDZ can provide an attractive income stream, particularly in today's low interest rate environment. With savings account rates hovering around 1%, a yield of 4.5% is certainly something to write home about. In conclusion, the iShares S&P/TSX Canadian Dividend Aristocrats Index ETF, or CDZ, is a top player in the Canadian dividend ETF space. With its focus on dividend aristocrats, broad sector exposure, and attractive yield, it represents a solid choice for income-focused investors. CDZ, with its focus on companies with a history of increasing their dividends, rounds out our top 3. There you have it, the top 3 dividend ETFs in Canada. To quickly recap what we've covered today, we delved into the world of dividend exchange-traded funds, specifically focusing on 3 standout performers in the Canadian market: VDY, XEI, and CDZ. Firstly, we looked at the Vanguard FTSE Canadian High Dividend Yield Index ETF, or VDY. This fund is renowned for its focus on high-yield Canadian stocks, primarily in the financial sector. Its low expense ratio and the stability of its returns make it a compelling choice for investors seeking consistent income. Next, we discussed the iShares S&P/TSX Composite High Dividend Index ETF, better known as XEI. This ETF offers a diversified exposure across various sectors, making it less risky compared to funds heavily concentrated in a single sector. It's a great option for those looking to balance their portfolio with a healthy mix of high-yielding stocks. Lastly, we explored the iShares S&P/TSX Canadian Dividend Aristocrats Index ETF CDZ. This fund is unique as it focuses on companies with a track record of increasing their dividends over time, the so-called dividend aristocrats. It's an excellent choice for investors looking for steady growth and increasing income over the years. Each of these ETFs brings something different to the table, and they all have their strengths. VDY is excellent for those seeking high yields and stability. XEI offers sector diversification and balanced risk, while CDZ provides potential for growth with its focus on dividend aristocrats. But remember, investing in these ETFs isn't just about the potential for high dividends. It's about the opportunity to invest in a broad range of companies in one go, diversifying your portfolio and spreading the risk. It's about the possibility of achieving steady income that can help you reach your long-term financial goals, whether it's saving for retirement, buying a house, or simply growing your wealth. Before making any investment decision, it's crucial to do your own research and consider your financial situation and investment goals. These ETFs, like any investment, carry risks, and it's essential to understand these risks before diving in. And with that, our journey through the top 3 dividend ETFs in Canada comes to a close. We hope this video has given you a clearer understanding of these investment options and their potential benefits. If you found this video helpful, do subscribe to our channel for more such insightful content. Don't forget to like this video and share it with your friends interested in investment. Until next time, happy investing.